Hi, this is Sean Overton with One Step Removed. In this video we're going to talk about price shading. Price shading is one of the games that Forex brokers play with their customers, and the purpose of this video is to make you aware of what price shading is, how it works, and how you can potentially make it work for you. Before we go into it, it's important to remember that the Forex market is over the counter, and what that means is there's no such thing as a real price. Forex, you can make up exactly what you want, and you can charge anything you want at any given time. So, how does it actually work? Well, there's an interbank market. Banks like Goldman Sachs, UBS, RBS, and a handful of other large banks are the ones that make markets, and they make markets with each other. So the closest thing you have to a real price is where those banks decide that the price is. Now, when you're trading as a retail customer, you're not usually dealing directly with those banks, you're dealing with a broker, usually one that offers MetaTrader. When you go through MetaTrader, what you're doing is receiving the aggregate feed from your broker, who then passes it on to you, but they're not necessarily showing you the real price that they're getting. So to go through an example, if you have a liquid currency and say interbank market's trading at 56 at 57, the bid-ask spread, if your broker just does straight pass-through, then they'll probably charge a pip for the service, so they might show you a spread like 56 at 58. Where the price shading comes in is if they're looking at the flow of orders between customers that are buying and selling the same currency. And if the broker detects an imbalance where too many retail traders are coming into the market on the buy side, that usually means that the market's going to go down, because always remember, most traders in the market are wrong. So if you see too many people going in one direction, good chance that the market's actually going to go the other way. As a broker, the way they take advantage of it is by, if the spread that they want to charge would be 56 at 58, and you know that everybody's going to come in buying, then what you can do is artificially move the spread up a pip. So instead of charging 56 at 58, you might charge 57 at 59. On the interbank market, you as a broker only have to pay 57, but your customers are coming in at 59. That means that instead of making your normal 1 pip markup, you're now making 2 pips. Now, the disadvantage to the broker is that if the customers start coming in the other way, where there's a flood of sell orders, they're actually losing money, because the bank is charging them 56. So if they're showing 57 at 59, now every time somebody comes in to sell, they're actually losing a pip. Where does this affect you? Well, if you tend to lose as a Forex trader, then you're almost always going to be on the wrong side. So what you can do is find a reliable spread that usually reflects where the actual market is trading, and then you compare your broker against it. If you notice that your broker is consistently on one side of the market, that it fluctuates either up all day or it's on the other side all day, chances are that broker is price shading. Now, if the broker has been in business for a while, that's probably a good indication of where volume is, because we don't have that available to us. And if your broker has been in business for a while, they probably know what they're doing. If you see that the broker is price shading to the upside and you see that the other price is below that, chances are they're having a flood of buy orders come in, which means they think the market is going to go down, and that's information that you can use to your own advantage. If you have any questions on this, my name is Sean Overton. You can find me at onestepremoved.com. It's the website behind me, so you know what it looks like. And if you want to email us, you can reach us at info@onestepremoved.com or call 866-212-1544. Thank you for listening.